If you are a business owner or an investor with portfolio of more than 2 crore rupees, you have likely noticed a frustrating trend over the last 12 months. Your mutual funds are struggling to beat the benchmark, with Nifty hovering around 25,700 to 25,800 mark in February 2026 and global volatility spiking due to US tariff wars and geopolitical friction. Traditional equity markets have become saturated. The buy and hold mutual fund strategy that worked brilliantly in 2021 is now facing severe alpha decay. Hi, I am Sirvesh Kutti. I am a former SEBI registered research analyst from 2020 to 2025, and I am the founder of SSG Wealth. Today, we are going to discuss how exactly and where exactly India's HNIs and ultra HNI individuals are quietly moving their capital to escape the volatility and to protect their wealth from inflation and also to generate highly structured double digit returns. Before we start the video, do subscribe to the channel for more personal finance content. So let's talk about the retail investors. Retail investors follow news, but institutional investors follow data. According to latest SEBI and CRISIL data released at the end of 2025, capital commitments to alternate investment funds AIFs have crossed a staggering 15.74 lakh crores. Over the last decade, the AIF and PMS space has compounded at a massive 31% CAGR. So why is this happening? Because smart money realizes that public markets are now crowded. The top 1% are pulling their surplus capital out of traditional mutual funds and moving it into category 2 and category 3 AIFs. They are trading daily liquidity for structured, predictable wealth creation. So, what is smart money actually buying? They are actually focusing on three primary structures that retail investors simply cannot access. Number one is private credit. While retail investors are fighting for 7% in bank FDs or volatile debt funds, AIFs are leading or lending directly to high growth corporations, securing yields of 12 to 14% backed by hard asset collateral. Second strategy is the pre-IPO equity. India's SME and startup ecosystem is booming. AIFs allowing HNIs to buy equity in late stage profitable companies 12 to 18 months before they hit the public stock exchange, and hence they are able to capture a maximum value upside before the IPO. And the third strategy is long short heads strategy. In a volatile 2026 market, Category 3 AIFs are hedging mechanisms to protect downside risk. When the market corrects, these funds are designed to preserve your capital while still capturing the upside. Now, there is a bigger advantage as well. And why is 2026 the specific tipping point for this? SEBI has recently completely overhauled the AIF regulatory landscape to make it incredibly lucrative for serious investors. SEBI has introduced streamlined co-investment vehicles or CIVs and relaxed the rules for accredited investors AI only schemes. So what does this mean for you as an HNI or a business owner? It means you are qualified HNI. You can now co-invest directly alongside massive institutional funds into specific high conviction deals with complete regulatory transparency and ring-faced bank accounts. The regulator is actively paving the way for wealthy Indians to participate in private markets with maximum safety. But here is the biggest tragedy I see with a lot of HNIs and business owners as a wealth architect. I speak to founders who run 50 crore companies, yet they leave 5 crore sitting idle in a 0% current account because they are afraid of the tax implication of extracting it as a dividend. They are losing potentially 30 lakh rupees or more per year to inflation simply by doing nothing. So there are certain strategies that tier 1 family offices are doing. Strategy in which they are sweeping their idle corporate cash into arbitrage mutual funds and corporate liquid fund for post tax efficiency, and then systematically deploying that surplus into category 2 AIFs to build generational wealth completely independent of their primary business. So the era of generic financial advice is over. If you are a business owner or an NRI or an HNI with a portfolio exceeding 2 crore rupees, you need an institutional architecture, not another stockbroker or a discount broker. At SSG Wealth, we act as the outsourced alternative wealth desk for founders. We audit your corporate treasury, optimize your liquid cash, and construct institutional grade AIF, PMS, uh, uh, you know, unlisted stocks as well as mutual fund portfolios completely tailored to your tax bracket. You can click the link in the description or pinned comment to apply for a free portfolio audit. Remember, this is not an investment advice, this is just portfolio audit where we will see how much capital your current setup is leaking and how we can restructure it for the next decade. So go ahead, click below and book your portfolio review now. And subscribe to the channel for more high-end personal finance and wealth generation content and topics. If you like this video, do give it a thumbs up as well and share your thoughts in the comment section. Thank you. Have a great day.